Introduction to IND AS 116. IND AS 116 is the Indian accounting standard that governs the recognition, measurement, presentation, and disclosure of leases. It aligns with IFRS 16 and replaces the previous standard, IND AS 17. The primary objective of IND AS 116 is to ensure a more transparent representation of lease transactions in financial statements by bringing most leases onto the balance sheet.
Key changes introduced. One of the most significant changes under IND AS 116 is the removal of the distinction between operating and financial leases for lessees. Instead, lessees must recognize a right of use asset and lease liability for nearly all leases. This ensures that lease commitments are reflected more accurately in financial statements, leading to better comparability among companies.
Leases are required to recognize a lease liability at the present value of future lease payments and a corresponding right of use asset. The lease liability is subsequently measured at amortized cost, while the right of use asset is depreciated over the lease term. This change affects financial metrics such as EBA, TDA, profit, and net debt.
Exemptions and practical experience. Indian AS 116 provides two key exemptions: short term leases with a term of 12 months or less, and low value asset leases, such as office furniture and laptops. Lessees can choose to expense these leases instead of recognizing them on the balance sheet. These exemptions offer flexibility and reduce the compliance burden for business with minor lease transactions.
Accounting treatment for lessors. Unlike lessees, lessors continue to classify leases as either finance lease or operating lease under IND AS 116. In a finance lease, the lessor de-recognizes the asset and records a lease receivable. In an operating lease, the asset remains on the lessor's balance sheet and lease income.
Impact on financial statements. IND AS 116 significantly affects the income statement and balance sheet. Lease expenses, which were previously classified as operating expenses, are now split into depreciation and interest cost. This results in a front-loaded expense recognition pattern where interest expenses are higher in the earlier year of the lease. The shift can impact financial ratios, tax calculation, and loan coverage.
Transition approaches. Companies transitioning to IND AS 116 can choose between the full retrospective approach, restating prior period financials, or the modified retrospective approach, adjusting only the current period figures. Most companies prefer the modified approach as it simplifies implementation while still ensuring Industry impact and challenges. IND AS 116 has a significant impact on industries with high lease exposure, such as retail, aviation, and logistics. These companies may see an increase in reported assets and liabilities, which could affect their borrowing capacity and financial ratios. Additionally, implementing the new standard requires changes to accounting systems and internal controls, which can be resolved in
Conclusions and key takeaways. India AS 116 enhances transparency in leasing accounting by ensuring that lease obligations are appropriately recognized in financial statements, while its implementation requires effort, it provides a clearer picture of a company's financial commitments.